Hello, my name is Lewis and this is not financial advice. You may be looking at this video because you need to know what a credit score is, how to improve it, and how it can actually make you money or save you money. Potentially, you're looking at buying your first home, or you're looking to use credit in some form of purchase. Maybe that's a loan to do some house improvements, to get a car or something like that. This video is going to answer those questions for you. So make sure you do subscribe to this channel, that you like the video, you share it with whoever you think needs to benefit from it, and comment in the comment section any questions you have around credit and I'll address them as best as I can as well. So what is a credit score and how does it affect you? First of all, a credit score really is a historic account of how it is you have been handling money, how you have borrowed money, how you've paid it back, and how good you have been at doing that. It's kind of like a scorecard that you would maybe get in school about your grades. It's kind of the system grading you for how you perform with money, how you act and how you manage money. I remember the first time I ever heard about this was when I was like a kid, and my dad was looking to buy a car. I heard him on the phone talking about credit scores and things like that. Didn't really pay much attention, didn't know what it was or anything like that. Later on, I was about 15 years old, very, very independent child, walking around town, going into a car phone warehouse, Phones for You. I wonder if any of you remember that or if you're too young. Looking at the best brick that I could afford to buy. Now, I couldn't actually get a phone on contract, which frustrated me because those were where the best deals were. So I had to go on pay as you go, unless my dad came on and was basically a guarantor for that contract. And by doing that, you're actually able to help build a credit score from a very, very early age. Little side tip there for you. If anyone out there is a parent, you can do that. Help your kids early to start building a credit score, because it's what is the history of how you behave with money, which is going to allow you to have a decent credit score, and that's going to open up opportunities for you. So when we say having a good credit score can make you money, it can also save you money, and we're going to talk about how it is that you do that. Now, everybody has a credit score, whether you've chosen to keep yourself separate from ever borrowing money because you think that's the best way to behave with money. It's not. Using credit is vitally important in the way the money system works today. If you ever want to buy a house, you're going to want to start building your credit score. It's not good enough to just be paying for things out of all the money you have. I know it should be, however, that is not the way the system works. Mortgages are given to you based upon how you have handled credit, loans, and debt in the past. Now, good debt, usable debt and manageable debt, not debt which is out of control that you've got on a million different credit cards and you can't actually afford to pay back. That's very, very bad debt. A mortgage, for example, is a good debt because it's something which has gone into an asset, slightly different. So you need to make sure that you are using your credit score. If you're not using your credit score, if you're not using the facility you have to attain credit and paying it back each month, then you're never going to grow a credit score to the point where you're going to be able to make money out of it. Little example on this, I'm going to use the home example because that's where most people start to look at credit scores and how it's impacting them. Two people work in the same job, they get paid the same, they live in the same area, and they're both looking to purchase the same house. So they both go to the same mortgage broker. Can you get the message here? Everything is the same. However, in the past, one of them has been using their credit card, they've been paying for stuff on credit, and they've been paying it back each month, no problems. The other person has never used a credit card, never wanted one, decided to just always use their debit card and pay for everything with the money they had in their account. Fine. Very, very virtuous. Doesn't work for a credit score. When they apply for the mortgage and the mortgage offer comes through, person one, who has used credit, gets told that they are going to get a mortgage rate of 3%. Person two, who has applied for the mortgage but has never used credit before, gets told they're going to be given a percentage rate of 4% on that mortgage. Now, why is that? What is the difference? Is that unfair? In one sense, it is unfair. But what's happened is the mortgage company is calculating their level of risk. And because of the credit score, because of that scorecard that they've each either been building or not been building, the first person who has used credit is deemed a lower risk to the mortgage company. Therefore, they can offer them a benefit, a bonus for being lower risk, and they get a lower percentage on their mortgage. Person two, who's never used credit before, is therefore deemed a higher risk, which is baffling, but is deemed a higher risk and therefore will not have as good a rate given to them by the mortgage company. So the lower interest rate that person A has received, now imagine you're the first person who has used credit, you're paying less on your mortgage. Less percentage on your mortgage means that you are paying less on a monthly, annual, full term of your mortgage. It could be worth hundreds of thousands of pounds at the end of that mortgage term because of 1% difference. Now, what are you going to do with that 1% difference? So person one who's been using credit is now getting better offers on their mortgages for the house that they're buying, is therefore able to use more disposable income, so they've got less to pay out, and they can actually reinvest that money into other areas. Now, when you're reinvesting that money, it may be 100, 200, 500 pounds on a monthly basis, and you compound that, meaning you let that grow, you let that grow, you let that grow, over the space of a 25-year, 30-year mortgage. That's a heck of a lot of money, which is now grown in investments versus having to go to the interest rates. It's so important that you make sure you've dialed in your credit score and you're improving it and you're working on it, because it impacts so many other areas, not just whether or not you can get the best rate on a mortgage for the property that you're buying. For example, it's going to affect the phone contract you can get access to, any electrical goods you might buy in a store, the different type of credit cards you can get and the bonuses you get with those credit cards as well, and which ones you actually have access to, home improvement loans, car finance. So if you rent your car or you have it on lease, you can get better deals on that because of a decent credit score as well. Insurance, all types of insurance. If you're paying them on a monthly, again, you get better access depending on how good your credit score is. Emergency finance, so if you have a boiler break, I'm going to think about those adverts now. Oh no, the boiler's broken. I've got to take the kids to school. We've just had a pizza, but I've got no money to pay for the boiler. Whatever will I do? Then that is emergency finance. And again, if you need that for any reason, if you have a good credit score historically, the rate you will pay on that emergency will be a lot lower. So it's massively important. It impacts so many different areas of our financial lives. So you need to start working on your credit score. You need to be aware as to where your current score is right now and how it is you can improve it. So it pays to have a good credit score. One of the tools that I use to keep track of my credit score on a week-to-week, monthly basis is a credit check company. They're called Experian. I'll put a link in the comment section. I use them to check my credit score, find out how good it is. If anything's happened, which is maybe a mistake, or if I've had a missed payment, which I don't have, so I make sure I keep my credit score high because I'm investing in property. It's really, really important that you do that. So use that link in the comment section. Go and have a look, see what your credit score is now, see how you can improve it, and make sure again that you subscribe to this channel for more details on this and how you can improve your credit score and improve your investing life and your financial life. Comment on this video with any questions you may have around credit scores and finance, and make sure you like this video and share it with somebody else to get the word out there about how important this stuff is. I'm Lewis. This is Not Financial Advice.